January 31st, 2026. Write that date down, because what happened on that single Friday may go down as one of the most violent events in the history of the silver market. Silver didn't dip, it didn't correct, it collapsed. Surprised 31% in a single trading day. In just a few hours, silver plunged from $120 to $78, wiping out billions in wealth and triggering the steepest one-day drop since the infamous collapse tied to Nelson Bunker Hunt and the Silver Thursday back in March of 1980. 46 years. That's how long it had been since the market witnessed something this violent. Retail investors were panicking. Exhales sharply. Social media was exploding with liquidation screenshots. Margin calls were hitting accounts across the globe. But behind the scenes, something very different was happening. While the crowd was selling in fear, the smart money was quietly buying. And once you see what actually triggered this crash, the entire event starts to look less like a disaster and more like a reset. Let's rewind 24 hours. Thursday evening, global markets were hit with a major political surprise. President Donald Trump announced the nomination of Kevin Warsh as the next chair of the Federal Reserve. Now, if you know Warsh's reputation, you know why markets reacted instantly. He's considered a hawk. That means higher interest rates, a stronger US dollar, and far less tolerance for aggressive money printing. For leveraged traders who were heavily long silver, this announcement was a nightmare. Within minutes, futures markets started shaking. Then the second domino fell. The CME Group, the exchange responsible for precious metals futures, raised margin requirements on silver overnight. And that's when the real panic began. Because when margin requirements rise, smaller traders are forced to either add cash or liquidate. Most didn't have the cash, so they sold. And once liquidation starts in a leveraged market, it doesn't move slowly. It cascades, stop losses trigger, algorithms accelerate the sell-off, and margin calls spread like wildfire. Within 48 hours, nearly $15 trillion was wiped from combined gold and silver market valuations. To put that into perspective, that's roughly half of the entire US economy disappearing in 2 days. Statistically speaking, events like this are called Six Sigma moves. In other words, they're not supposed to happen. But this one did. And right in the middle of that chaos, one of the biggest players on Wall Street made a move that caught the attention of professional traders. JP Chase quietly closed nearly $10 billion worth of silver short positions, not before the crash, not hours after, but exactly at the market bottom, around $78, the precise low of the entire sell-off. Coincidence? Maybe. But seasoned traders know this pattern well. When panic hits retail investors, large institutions often use that moment to reposition. And when you zoom out and look at the fundamentals of the silver market, their confidence starts to make sense. Because beneath the volatility, the silver market has a problem, a supply problem. For 6 consecutive years, global silver demand has exceeded total supply. According to projections from the Silver Institute, the market is expected to face a 117 million ounce deficit in 2026 alone. And production isn't catching up. Fresnillo plc, the world's largest primary silver miner, recently cut its 2026 production guidance for the second time. Meanwhile, Hecla Mining expects this year's output to fall below its 2025 production levels. In other words, supply isn't stabilizing, it's tightening. At the same time, demand isn't slowing down, it's accelerating from 3 different directions. Solar energy installations alone are expected to consume over 120 million ounces of silver in 2026. Electric vehicle adoption continues to surge. US EV sales jumped nearly 20% between 2024 and 2025. And each EV requires roughly twice the silver of a traditional gas-powered vehicle. And now a new player has entered the demand equation: artificial intelligence infrastructure. AI-focused data centers and high-performance servers are now using 3.5 times more silver than traditional computing hardware due to advanced circuitry and thermal management. These aren't speculative forecasts. These are contracts already signed, factories already operating, and infrastructure already being built. That's why major financial institutions didn't interpret the January collapse as the end of the silver bull market. Bank of America and Citigroup both described the crash as a correction within a long-term structural uptrend. And legendary commodities trader Peter Brandt, who actually predicted the January drop, turned bullish immediately after it happened. Another indicator traders are watching closely is the gold-to-silver ratio. At the height of the rally earlier this year, the ratio compressed to 31-1. Today, it sits closer to 60-1. Historically, when the ratio expands like this during a precious metal cycle, silver tends to outperform gold dramatically in the next phase. Fast forward to today, March 13th, 2026. Silver is trading around $85 per ounce, nearly 10% above the crash low. The big question now facing the market is simple. Can the structural supply deficit, the explosive industrial demand, and quiet institutional accumulation overcome a strong US dollar and a hawkish Federal Reserve? Because if history has taught us anything about commodities, it's that fundamentals eventually win. And if the institutions who loaded up at $78 are right, January 31st, 2026 won't be remembered as the day silver collapsed. It may be remembered as the day the next phase of the bull market quietly began.